Hi friends, good evening to you all and welcome to this conference call. This is as part of our regular interaction with our sales team. We have today with us Mr. Balaji Vaidyanath. You all know Balaji, he is our research partner to our portfolios, and you know that he is partnering with us for long years, and he's been advising for our portfolios like uh, Advantage and Freedom portfolio. And both these portfolios are top performers in the country for many months. And even now, if you look at last 1 year period, our Advantage portfolio is outperforming the benchmark in a huge way, not only for 1 year period, for all the period for that matter, but the 1 year period, especially because market is down. If you look at the indices for last 1 year, market is down, but still our portfolios are performing very well, especially the Advantage portfolio. And now across the globe, market is undergoing a correction. A lot of concerns over inflation and interest rate hike, and crude oil prices also going up. So in this scenario, what strategies to be done? What is to be adopted for as a portfolio manager? That thing will be discussed here. And Mr. Balaji Vaidyanath will take us through on the current market situation as well. So now with this note, I request Balaji to take over this session and just take us through on the current market situation. Balaji,
Dilip, can you hear me?
yes, we can.
Yeah. Thank you. Thank you for the introduction, Dilip, and good evening and a warm welcome to all of you. Thank you for taking the time out and being part of this call. We've been like interacting physically and virtually for a few years now, and once again, we are at a crucial phase in the markets where after a very unidirectional rally that we saw in most of 2020 and 2021, we have seen the first real test as far as the markets are concerned, with the Nifty having fallen almost 18% from the peak, and today especially it has touched the 52-week low. Uh, Similarly, many stocks are down between anywhere between 15 to 50-60%, depending on the category that they are present in. If especially the new age stocks, where a lot was spoken about sometime last year and the last 1.5 years, especially. Uh, New types of valuation methodologies were used to justify companies that are not generating any types of cash flows. They were burning cash, but still, markets were trying to justify those companies. We even had IPOs of many of those companies which are having a lot of cash burn without any cash flows. The poster child for this new age business is we also saw that the same thing happened in the US, with one particular fund manager focusing only on this in the name of ARK Investments. And there, the portfolio is down by 70-80%. So once again, market reminding that there is no substitute for fundamentals and cash flows. And, this time is different. It's not really there. So you have to pay heed to valuations. Market once again teaching old lessons to some of the new investors who started this sometime in 2020. Uh, Correction in Indian markets is not an isolated phenomenon. So even if you look at U.S. markets, we've had a great fall in the U.S. markets. For example, if you take Nasdaq, only about 12% of the stocks are above the 200-day moving average. 88% of the stocks are below 200-day moving average. Similarly, if you look at Nifty 500, close to 20% of the stocks are above 200-day moving average, and balance 80% is below 200-day moving average. So we've had a significant correction, and depending on the category, the correction has been very sharp and severe. So like I mentioned, the new age fintech companies are down 50, 60, 70%. If you're a consumer company, you're down maybe 5-10%. If you're a manufacturing company or a chemical company, you're down 20-25%, and so on and so forth. Uh, So it's not like we have escaped from the fall or anything. Even we have fallen at the portfolio level. I think we must be down about 8% from the peak levels. So uh, we've also kind of the only saving grace for us is that in our portfolio we do not have some of these new tech names or companies without cash flows, etc. So that has kind of saved us from a sharper correction as far as the markets are concerned. So that is obviously something to cheer about, because we are not present in that segment of the market uh, uh, where there are no cash flows. So all companies, both in the advantage portfolio and the freedom portfolio, are profitable. Debt equity ratio is less than zero point 0.3 times. Return ratios are in excess of 18 to 20%. On a weighted average basis, both the portfolios are growing their earnings by around 20% plus. So we have been paying importance to cash flows and fundamentals rather than purely, having a narrative-based portfolio, which will eventually turn out to be a hope trade rather than a trade that is backed by solid fundamentals. Uh, so we had this huge easing mode in 2020 when central banks across the world, especially the US, went into a huge easing mode, followed by Europe and some of the other countries as well. So liquidity was available in plenty, which also explained the crazy ride in some of these fintech names, cryptocurrencies, non-fungible tokens, and so on and so forth. So now with the first sign of tightening because of inflation, we are seeing that risk assets are being sold off quite significantly. So we have Bitcoin, which is down almost 60% from its high. Non-fungible tokens are down 80-90%. So that game is almost over. And thanks to unprecedented inflation, the central banks have moved into a tightening mode. So, for example, last night we had a 75 basis points hike as far as the Federal Reserve interest rate hike is concerned. So the solution to every problem, as they say, is to first acknowledge the problem. So that first step is already taken, which is that acknowledging that inflation is turning out to be a problem. So the second step is to address the inflation, which is also being done by the way of increasing the interest rates. So we have already seen the impact of that. We have already seen the effect of increasing interest rates and tightening liquidity conditions, because we are seeing a scenario where commodity prices except oil have already started correcting. So if you look at copper, it's at a 52-week low. Aluminum is corrected significantly. Iron ore and steel has corrected significantly. Many commodities, including agri commodities, the prices have fallen pretty reasonably. So the 8.6% print that we saw as the inflation number in US will definitely have some amount of lag impact, because the recent correction in those prices have not yet been factored into it. So we will start seeing that inflation beginning to cool off. So much so that by next year, same time when we are having this conference call, who knows that we may be discussing about deflation at that point in time rather than inflation. So uh, um, so this is already happening now, and risk assets have been sold off, commodities have come off highs, etc. So this is basically getting valuations back on track, right? So today we have Nifty at 15,300, and even after accounting for any kind of earnings downgrades, etc., you could look at possibly a 900 to 950 rupees EPS for Nifty for next year, which means that the Nifty is close to about 16p multiple at this point in time, which is definitely not on the higher side compared to which at one point in time was as high as 22 23p p multiple. So this correction means that even if there had not been COVID, for example, 2020 February is when was the before COVID period. Nifty was something like 12,500 at that point in time. So even if you were to factor in a nominal 10% kind of growth for 2 years, so we are looking at a 14,700, assuming that there was no COVID at all over the last 2 years. Nifty could have been closer to a 14,700 kind of a number, which is where it is. We are probably 800, 900 points more than that level. But just to give you a sense of what could be a possible bottom, it's impossible to find the exact bottom. We can only speak about it in probabilities. So in probability that, assuming that, nominal GDP growth of 10%, 11%, and Nifty earnings growth of 10, 11%, which has been the case from 2000 till date. So if we were to factor that in, then Nifty should have ideally been at about 14,700 levels. So today Nifty is at 15,500. So about anywhere between 700 to 800 points more than what it should have theoretically been at. Many mid caps and small cap stocks are already at levels where Nifty was at 12,000 or 13,000 levels, because the fall has been even more steeper in the mid cap and the small cap categories. So this is essentially the correction that people have been waiting for. I mean, the people who have missed the bus, the people who remained in cash in 2020 and missed out on the rally in the whole of 2020 and 21, and every time they kind of wait on the sidelines for the markets to correct, but markets never really gave any kind of a meaningful entry opportunity. But today, we are having that entry opportunity. So this is the correction that you and your clients would have been waiting for maybe 6 months back or 1 year back. So today we are having that correction. So this phase is not something that is that is new. Geopolitical events have always been there for from time immemorial. So we had this huge MENA crisis in 2011. We had the pigs crisis in 2010. We had the Brexit situation in 2016. We had the Russia, annexing Crimea sometime in 2014. Then 2018 we had the trade war, and locally we had island FS crisis and things like that. So every time, markets have been able to climb the wall of worries, and we've kind of made newer highs, right? So this is again one very deep, steep correction, meaningful correction that we have seen in the markets, which has also kind of in a way taken away the froth as far as valuations are concerned. Not to say that stocks have become mouthwateringly attractive or anything of that sort. The expensive stocks still continue to be fairly expensive. But I'm saying that overall at the index level, we are seeing a fair amount of you know correction which has happened. And of course, as always in the portfolio, we are following a bucketed approach. We try to invest in a mix of multi-baggers, not multi-baggers, but compounders, where we believe that earnings can kind of keep growing at 1.5 to 2 times the GDP growth of the country, assuming that the GDP growth is about 10, 11% at the nominal level, about 15 to 20% growth as far as the earnings are concerned. So those types of stocks are basically the compounding stocks, which can keep compounding their denominator, which is the earnings, by about 15 to 20%. The second set of stocks are essentially the capex related stocks, where we invest in companies that are actually undergoing a huge capex program at this point in time, in the hope that once the capex comes on board and once the capex is commissioned, there is a opportunity to make money as the cash flows start kicking in. Usually, when companies enter into capex mode, the stock prices go into a kind of a lull, and there is a fair amount of underperformance in those types of names. So it is at that time that you get the stock that you want at the price that you desire. So in this game of markets, when valuations are very attractive, sometimes fundamentals may not be all that attractive at that point in time. But when fundamentals are extremely attractive, valuations may be very, very expensive. So it is very difficult to find, a combination where fundamentals are extremely attractive and valuations are cheap. So at some point in time, you have to compromise on this or that. So we try to have a good mix of that in the portfolio, where we believe that even if fundamentals in terms of earnings growth is not going to happen on an immediate basis, but there is a reasonable amount of visibility, say 8 quarters down the line. then we kind of look at those kind of ideas very positively and hold on to it. With metal prices getting corrected, etc. So we are also trying to, kind of get into certain segments where, there has been a fair amount of underperformance so far, where there is a contra opportunity which is possible, in the sense that if you look at the auto sector, for example, the auto sector has been beaten black and blue for almost 4 to 5 years due to very many reasons, starting from Bharat State 6 emission norms. It was followed by very high GST rates. Then it was followed by, higher commodity prices. Then, this shortage of semiconductor chips. Then disruption due to electric vehicles and so on and so forth. So the prices and the valuations of auto companies are looking fairly attractive. So if one were to take a 3-year view or a 4-year view, so within Nifty, the profit pools can shift from metal companies to the auto companies. So auto companies, if someone were to take a 3-4 year view, there is very little to lose and there is a lot to gain from a probability point of view. Semiconductor prices are already down 40-50%. GST has been well into the system for 5 years now, and Bharat state exemption norms have been implemented. Volumes have been low, so the base is very, very favorable and attractive. So all this put together, you could see fair bit of recovery happening in the auto sector. So we are liking these names, and we would look to add more into this sector, in the coming quarters. Similarly, mid-cap banks is another sector where we feel that there is a lot of value that is available now. Banking sector as a whole has gone through a lot of underperformance over the last 2 to 3 years. Even the best of the banks, such as HDFC Bank and Kotak Bank, have seen a fair amount of underperformance. Some of the mid-cap banks, a lot of these banks have cleaned up their balance sheets, and numbers are looking pretty neat and clean, and it is available at less than 0.5 times in terms of price to book. So we are taking a 2-3 year view on these companies, and we are making investments in these types of companies. So the portfolio has a good mix of compounders, and it has a good mix of certain special situation events, and it has a good mix of capex related upsides to it. So like I've always been mentioning that, for any kind of portfolio, especially like our mid advantage portfolio, which is skewed towards the mid caps and the small caps, one need not have, if someone were to come with a 5-year view, you don't need to perform all the 5 years to deliver the results to the clients. The portfolio can have one very good year, it can have one bad year, and 3 average years, and still, we'll be able to beat the benchmark and be able to give quartile one performance to the clients. So this time again is no different. After 2000, after a very good 2020 and 2021, we are seeing a fair amount of grind in 2022. So we don't know if it's going to bottom immediately or it's going to take another 4-5 months, 6 months, etc. But these are, we are already at buy zones, in most of these counters and most of the sectors. So, as of 2022, if one were to take a 4-5 year view and look at 2026 or 27, then these are great opportunities to enter into it. So quantitative easing and the Fed tightening is something that's been spoken about. It's become mainstream. Inflation has become very mainstream now. This is being discussed in the not only in the financial media but even the non-financial media. So every time when a financial news makes headlines in a non-financial newspaper, then it is more or less the peak for that particular topic. We have seen it in the past in very many things happening there. Now it's happening in inflation. So I think if 6 months, 9 months, 1 year down the line, inflation will again be something that's put onto the back burner in our humble opinion. So so with that kind of a view, I think valuations have started looking attractive across very many sectors. And for those people who have been waiting on sidelines, waiting for a correction, It's not possible to catch the exact bottom. It could be 13,500, it could be 15,000 or whatever it is. But with a 4-year view or a 5-year view, the probabilities are looking fairly decent. Quantitative easing has not been there continuously. We have had phases. We've had phases where quantitative easing was stopped. Between 2014 to 2019, there was no quantitative easing. In fact, there was quantitative tightening for almost 2 years, and Federal Reserve actually hiked the interest rates by 7 to 8 times, and markets actually made new highs. S&P 500 of US delivered about 85% returns at that point in time before the Fed eventually started the quantitative easing again. So QE is not the end of the world. We've had significant outperformance of markets even during the non-QE times as well. Uh, so we've seen excellent amount of outperformance by the U.S. stock markets vis-a-vis the Indian stock markets in the previous decade between 2010 to 2019, largely led by the tech stocks in the U.S. So between 2020 and 2030, can we see a situation where India outperforms the US? The probability is fairly high. For starters, we are seeing a reasonable amount of positive investment climate. Manufacturing is continuing to do well. We are gaining market share from other countries such as China in segments like home textiles, in segments like other manufacturing products. Uh, in the next 5 to 7 years, we will be making some mark in semiconductor manufacturing, for example. Uh, and whether it is chemicals or specialty chemicals or other infrastructure related place, I think there is a fair amount of traction in those sectors as well. This entire COVID related situation and the eventual China plus one kind of a strategy is something that is playing out. People want an additional kind of supply source for some of the key products, and that is something which is happening. And one of the other main reasons for inflation, I mean, 100% of the reason is being attributed to the easy monetary policy of the Federal Reserve, which may not necessarily be true. There is a fair amount of inflation also because of the disruption to the global supply chain. Shipping routes have gone for a toss. Ships which were sailing, say, goods required to manufacture chappal or footwear, are are being used to kind of move wheat or other food items between one country and another country. So if you want to kind of export footwear or raw materials to make footwear, you can still export it, but it's going to cost you 3x more. So the shipping routes have undergone a disruption. The rates have undergone a disruption. So all that is kind of reflecting in the end prices in the form of inflation. So at some point in time, the global supply chain will revert to normalcy, and when that happens, you're going to see that inflation is going to cool off even more. So these are some important aspects to be kept in mind. I think I mean, the markets have kind of given the correction which people have desired for the last 2 years, and one can use this as an opportunity to enter into either add to the existing positions or make fresh allocations. As far as the portfolios are concerned, we are having about 6 to 7% cash. Uh, so we will be using this cash to add on to the stocks that we like, and we will also use this correction to get into some newer ideas, and reshuffle the portfolio here and there and get into some newer ideas based on how attractive they become. So this is a constant exercise that we are doing. We never use cash as a huge tool to navigate correction. So we will never have a 20% or a 25% kind of a cash level. So as cliched as it may sound, if you go back and look at the history of any successful investor, both at the public level and at a private level, they've always made their success with uh, having been almost fully invested, and they don't use cash as a tool to navigate correction. In fact, they use their existing positions to kind of reshuffle their portfolios and to get into better names. And we have been also doing that for the last very many years, and we propose to and desire to continue to do that in the foreseeable future. So this is our snapshot, our thought process in terms of where we are and what we feel about the markets, etc. And so now I'll be very happy to answer any questions that you may have. Thank you.
Thank you, Balaji. Thank you for your market roundup. And now, participants, if you have any questions, you can type your questions in the chat box. Balaji, I have a question with that. This is with regard to selling of FIIs in the market. If you look at market for last many months, they are net sellers in the market. If you look at since January, they've already sold more than 2.5 lakh crores in the market. This is one among the highest selling by FIIs in the market. And we know that at some point in time, they will have to be net buyers in the market. But how long? Now the investors who are looking at topping up their investment now, this is one concern, because whenever there is an opportunity for FIIs to sell, for every movement in the market, they are using as a selling opportunity. So what is your view on, is there any particular reason for the FIIs continuously selling in the market nowadays?
So, FIs have been heavy owners of banks and financial services, across the Indian markets, especially the private sector banks. And yeah, so, they've been, trimming their positions in most of the emerging markets. It is not just the Indian markets that, we are seeing this kind of FI selling. In most emerging markets, we are seeing this type of selling which is happening. And the selling from an absolute number point of view may look pretty high, but as a percentage of market cap, it is very similar to their past selling. We are looking at the absolute number, and we think that we are comparing this absolute number to the previous absolute number, and we think that the selling has actually increased. So that may be partially right, but if you actually look at FIS selling as a percentage of their total holdings and as a percentage of their total market cap, then it is very similar to the 2020 selling, etc. So also, when you are making losses and when there is a redemption pressure in some of the other markets, automatically you also tend to reduce your positions where you are sitting on decent profits. And other markets where you've already made some amount of money. So that is something we are witnessing, right? So whether it is China or Russia, when there is redemption pressure related to this, you are going to see that spillover effect happening to Indian markets as well, because we are a global interconnected world. So that is going to have its impact here in India as well. So very difficult to pinpoint and say that the FI selling is going to stop during this time, or we don't know that. But I think uh, what has to be kept in mind is that valuations. If you are paying the right price for a stock, then you don't, whether it is an FI or a DII, or at any point, at some point in time, the value gets unlocked, and you are able to make your return. So a lot of the mid cap companies, for example, or the small cap companies which eventually become mid caps, this re-rating is not necessarily because of FIIs. FIIs, that top 30 stocks, they'll be having 80% of their holding in the top 30 stocks. The balance 20% will be spread across very many smaller stocks. But that doesn't mean that every re-rating that happens in India is because of FIIs. So, FIIs eventually come, and they also have their limits and minimum market cap criteria, etc. So, in the mid cap segment or in the small cap segment, uh, if you pay the right price for a particular company and buy it, then whether it is FII or DII, at some point in time, value gets unlocked. When by which form it gets unlocked, it's difficult to say. But I'm sure that when you are the fastest growing economy in the world, etc., and when you have such attributes, you're going to see lion's share of allocation happen to India sometime in the near future, basically.
Yeah. Thank you. You are talking about 2020-30 period will be good for India and especially for a few sectors like semiconductors or home textile kind of industry. So if you look at our portfolio, we have a huge exposure into auto, banking and others. Do you have any plan to include any of the stocks from these particular sectors, or do you bet on any other sectors for going forward?
So yeah, I mean, home textiles, auto and banking, we already have reasonable exposure. Semiconductors, there is no direct play in semiconductors. There is only indirect play, in the form of Linde. So we are looking at Linde India as a possible opportunity to play the semiconductor sector, and not only semiconductor, but industrial gas as a segment as a whole, where if manufacturing picks up, you will need a lot of industrial gas, be it oxygen, nitrogen, argon, all those are going to see a good amount of growth, basically. Power sector is also undergoing a lot of transition. You're going to see a reasonable amount of power capacity addition on the solar side. So everybody in the value chain, including the solar glass panel manufacturer to the solar gas manufacturer, etc., are going to see a reasonable amount of growth. So we are having an open mind and looking at a lot of these sectors, and we'll continue to kind of keep adding into some of these sectors.
Uh,
Do
Dilip,
you expect any? Yeah. Yes,
Dilip,
yes, Bijoy.
connected to the question which one of the employee have asked, I want to add on that. Hi, Balaji, Bijoy here.
Have you joined?
See, we have been hearing on this rumor since a quarter or more that there is an expected recession in global economy, especially in US, and which will be continued in Europe. And it's also said, I mean, these are rumors what we hear from the customers, I mean, should the customers stay in debt funds and bond funds for next 12 to 18 months because of this recession alarm which is already on? What is your view on this?
See, it is because of the fears of recession only. We have seen a huge correction in the U.S. market, and not so much in the Indian market, basically. So, whatever is happening in US, it's not necessary that it has to happen in India as well, right? So in 2010 to 19, US significantly outperformed India. There is nothing which stops India from outperforming the US over the next 5 to 10 years. That is also possible. And just because US goes into a recession doesn't mean that flows will kind of halt, or things will become negative for India as well. So we are already seeing signs where although the US numbers are not great, the US powers seem to be waning, but at the same time the rest of the markets have not really kind of taken as much of an impact as the US markets. The rest of the world seems to be outperforming the US, and it can well be the case in the years to come as well. I mean, recession sometimes, as part of the cycle, it becomes unavoidable, right? So what is the definition of a bear market? Bear market is when you say that index falls 20%. So index has already fallen 18% as far as Nifty is concerned. US markets, index has already fallen, and many stocks are down 30, 40, 50% also. So it is because of those fears that the correction has already happened. So when the actual thing comes about, the markets might be pricing something else. The markets will once again start pricing in a recovery. We have to understand that the cycles have become extremely short. It is gone are the days when we had a 5 year or a 7 year cycle, and so on and so forth. Cycles have become very short. We are having 2 years of boom bust cycles. So to that extent, it is, if you are having a good company, if you're present in a good industry, it's not it does not make sense to kind of keep playing it for the short term. We can play across 3 to 4 cycles in the same stock and the sector and make our money. So it's not necessary that we have to go right in every mini cycle and try to capture that opportunity basically.
Yeah, thanks, Balaji. Or to Dilip.
What is your view on inflation in India, Balaji? Whether this interest rate hike which is happening today that will help to control the inflation?
Definitely, that's what I mentioned in my opening remarks also, right? So uh, the desired results are already happening. So you name any commodity except oil, everything has kind of cooled off significantly. Iron ore, copper, steel, aluminum, pipes, agri commodities, all of them have corrected. So much so that next year, we could be starting at the possibility of deflation. So that has already happened, and so the central banks have been kind of successful in making inflation as the center point, and trying to control that. So commodity prices have fallen, and automatically that will start reflecting in the mainstream inflation numbers with a lag.
Okay. And now, no more questions now. Bijoy, do you have anything as a concluding remarks? If there is no more questions, then we can just wind up this call.
Perfectly fine. Thanks, Balaji. As usual, every time we speak to you, we feel good. We get more confident to get back to the market. This time we have this is an exclusive session only for employees. We have almost 500 participants across the country, all employees, all verticals put together. Thanks again. And as you rightly said, this may not be the bottom, but however, we feel this should be the app time for any new customers to get in. It's a buying zone, buying time. So team, as we always says, it's already 15-16% corrected market. Best time for new clients to get into this get into this product PMS investment. And I urge all of you to keep moving, keep speaking to your clients, and let's see more of the PMS numbers coming in. We will be putting this recorded version in the chat box. So if some of you would like to hear it again, maybe in another half an hour, 1 hour, we'll be putting this in the chat box. You can listen to it again. So with this, thank you. Thank you, Balaji. Thank you, Dilip.
Thank you, Vijay. Thank you, Dilip. Thank you all. Wish you all the best.